Welcome everyone to the Marsh webinar on trade credit insurance. We will be starting our program very shortly. We have a number of participants logging in. Akshay or Niladri, can you put the first slide on the screen? A very good afternoon to all the participants who have logged in. I can see many more are logging in as I welcome all of you. Without delaying, we will start the program on time so that we can end the program on time. I am Sanjay Kedia, Country Head and CEO for Marsh India. I'm pleased to welcome all of you for this webinar, which is a series of excellence in insurance and risk management launched by Marsh in the month of October and November. I'm pleased to have the subject of credit risk and its risk management strategies and have a panel of experts which we believe is the best in class speakers we have within the Marsh world. We have with them over here with us on the panel. So let me introduce the panel we have for today. Next slide. We have Tim Smith, our global trade credit practice leader from London, here with us today. We have also Tyler, who is based in Hong Kong and leads our Asia practice for this business, and also Akshay Bhardwaj, whom all of you would know very well. He leads our India practice. We all know COVID has brought in a number of risks for all of us to consider. It's very interesting to see the recent survey launched by Marsh and McLennan companies for the World Economic Forum as part of the COVID risk findings. The top two risks which emerge on this global survey from the participants is one, prolonged recession of the global economy, and two, surge in bankruptcies and a wave of industry consolidation. And as you look through the other risks, many of them goes on to accentuate the credit risk, the bankruptcy risk, which we are going to be discussing today. What we are seeing across the globe, we are having an unprecedented central bank-led influx of liquidity in the system, and that is to manage, among many things, one of the most important things is to manage the credit risk and the bankruptcy risk we all face with this downward business in many sectors and more so in few sectors more. If I was to make some quick opening remarks, one, whenever a shock event has happened, and we have seen in the recent last financial crisis also in 2007 and 2008, the bankruptcy risk rose to the very much on the top tier. And same we are saying on a COVID risk, where we all know it's a medical situation, a humanitarian crisis, but the bankruptcy and the credit risk shoots on the top very quickly from an economic perspective. And that is what is also projected going forward as well, that whenever we have a major shock risk event across the globe, the bankruptcy risk tends to shoot up. And that's where you see all the action from the central banks and so on and so forth. This risk really shoots up very quickly. That's the nature of the risk. It will be important to share and look at the past and share a story that in 2007, just before the financial crisis, Marsh India conducted a survey of all the IT companies in India, and the risk on the receivables, that is a customer risk, they put it at the bottom. They had all the other risks, but not the customer risk. And comes the financial crisis, this very much hits the top. And it's very natural because the IT companies in India said, we are dealing with the largest corporations of the world, and many of them have very superior rating compared to the sovereign rating of the country also of India. But things change very dramatically when a major shock events happen. I recollect many of the top IT companies started considering credit insurance. And now with this COVID, many more have moved into the credit insurance, and now very few are left who are not using credit insurance as a tool. So that's a major transformation in the last 15 years of one end to the other spectrum. In this COVID, we have seen among many classes of insurance product, credit insurance, which has not only the surge of demand is there for future buying, but also claims are happening and are being paid. So I'm sure Tim and others will take you through more details, but in summary, I would say claims are up, insurance rates are up, capacity and limits are down, and the interest from buyers is up. That's a quick summary of where we are on this whole scheme of things. Indian insurance market on credit is more like an exception on the regulatory front, where the use of credit insurance for bank financing was specifically disallowed many years back, and this has not still been restored. Marsh has led the demand with the regulator and has facilitated dialogues with many major banks and many customers with the insurance regulator. I'm pleased to share that all the efforts of collective, all of us who are today on the webinar, many of you have been participating in that effort. Regulator is already launched the final version of the report in public domain for final comments, and I'm here that it should be out hopefully in less than a month, and it will be a reality. And Indian market will now become in line with the rest of the global markets where credit insurance can be used also for bank financing. So that will be a major progress, and particularly during these COVID times. I'm sure we have a lot of expert comments coming from Tim, Tyler, and Akshay as a moderator. So I'll hand it over to Akshay. I would encourage all of you to make this a very interactive session and use as many question and answer. And you don't need to wait till the end. If you have a question in your mind, just type it out in the Q&A tab, and we'll be very happy to engage with you. So with this, I hand over to Akshay, and thanks all of you for joining us today.
Thank you, Sanjay. I think that's a great introduction. Yes, we are seeing this surge. So before I speak, I'll just give the agenda to our participants. I'll give you a brief update on trade credit insurance, and then we will move on to listen from the experts the purpose of our joining in here in terms of reading the situation, understanding the sectors and geographies, using trade credit insurance for substance and growth, and supply chain disruption and the way forward, the idea of how things are changing, and we conclude with your question and answers. So basically, if you look at probably first time in history since World War II, almost 200 countries have seen a rating downgrade. In the world, GDP has, it is expected that it will lose out to economic output worth 3.5 trillion. And we all are aware that post World War II, the world stride in decades, the world stride towards World Trade Organization, a global seamless supply chain, free trade, borderless world, etc., etc. But as the crisis changed the world order, this crisis of such magnitude is seeing a change in trade patterns, taxation, competition rules, etc., which were nurtured by neoliberals across the many years. COVID-19 pandemic has actually shown us that governments, businesses, or civil society groups acting alone cannot meet systemic global challenge. And we need to break down these silos to keep these domains separate and start to build an institutional platform for public and private cooperation. So before we move our first question to Tim, I would like to take you through a few poll questions. So the first poll is in front of you, and I want everybody to participate. The question is, do you think that in this pandemic, there is a possibility that some of your customers may default on your payments? Please do vote. This reflects your sentiments. The best part is that most. So yes, this is a reality that everybody agrees. So almost 70% people agree or strongly agree that there is a possibility of the customers defaulting in current situation. Do we have the next poll question, please? Yeah. So what I'll do is I'll just take you through the basics of trade credit. As we know, cash flow is the key. Cash flow is the key for any business. What we are talking about is a buyer-seller relationship. And it is every business's endeavor to find the right buyer, extend the right amount of credit, timely collection, and effective recovery. And these are not only the challenges, there only lies the opportunity. And trade credit insurance across the years have provided itself as the one-stop solution for all these worries. Next slide, please. So broadly, what trade credit covers is domestic and export receivable risk both. It is bought to take care of the receivable risk against insolvency of the buyer and protect a default. For exports, we can cover political risk as well, that is public government default, currency inconvertibility, or any government action which stops you from taking your receivables out of your buyer's country. Next slide, please. Now, who uses trade credit insurance? Global best practices is that almost 50% of the business trade credit comes from banks and financial institutes who run large size factoring programs, bill discounting programs to provide cash management solutions or cash flow solutions to their clients. It is also bought by companies to take care of their receivable risk, where they are not looking for a cash flow solution, but purely from the receivable risk. And this type of customers are spread across chemicals, ICT, food and beverages, pharmacies, commodity, you name it, everybody has it. This particular challenge, as Sanjay suggested, that in India currently banks cannot buy or financial institutions cannot buy the credit insurance policies. But as we all have worked hard, we believe that within this year or maybe in this month or next month, this should be up and out. Next slide, please. Now, what do we look at in terms of overall benefit when we talk about what credit insurance does is it helps you protect your bad debt in terms of turning bad. So it's a risk prevention tool, it's a risk transfer tool. Now, what people do not understand that it also brings in a lot of credit discipline to the business, wherein it helps you benchmark your credit exposure on every buyer to ensure that you are only giving him the right amount of credit. And the assessment of the insurer when it comes to you, it does not come as an information, but they are participating in the risk. So whatever is coming to you that, okay, X buyer, the exposure should be Y, insurers are standing behind that limit, what they are confirming. The best part is that this particular business have a worldwide acceptability. And at any point of time, at least 70 million buyers are actively being assessed by these insurers. So if you have a client or if you have a buyer whom you want to sell, or if you're selling to a buyer already, there is a very high probability that this buyer is also being assessed from from a 360-degree point of view. So you always get an updated information. One very important aspect is obviously working capital enhancement situation. But unfortunately, though it is not available in India, but it will happen. I'll not repeat that part again and again. So this are small statistics or example what we have done, that if a company is operating on a 5% profit margin and it suffers just $100,000 bad debt, then they have to generate an additional sales of 2 million to replace this lost money. And in current situation, having a loss of even $100,000 can throw the profitability goals out of window. Next slide, please. Next slide, please. Now, with respect to what type of covers are available, you can look at covering your whole turnover, whole credit turnover. You can have a sectoral selection of buyers in terms of top buyer or a certain segment or a certain geography. You can also go for a single buyer coverage for specific sales, which is also available. Next slide, please. Now, why should one consider trade credit insurance? I have already shared with you. Obviously, it provides financial protection to the book. It ensures that we do not get into a loss situation. And if we do get into a loss situation, there is an active debt recovery which is done by the insurers to ensure that that your money is recovered before it actually turns bad. And I'm happy to share that for most of the insurers, the debt recovery percentage before a claim is actually paid is as high as 40%. So in 40% of the chances, you will get your full money in, your policy will remain healthy, and your money will be saved. It helps you in sales growth in current scenario, and Tim and Tyler will speak about it. Trade credit is a great tool whenever you are entering a new market or entering into a new business relationship. It enhances your quality of buyer because it weeds out the bad buyers out of it, and obviously the working capital management. Next slide, please. And can we have the full question, please? Now, the question is, since the pandemic intensified at the beginning of the year, have you experienced a delay in payment from your clients? I request everyone to participate because it provides a lot of insight as to what your mood is. Now, indeed, this is a very shocking figure where 95% have faced delays of which 15% have seen extreme delays and 28% slightly less than extreme. Now, these are actually scary figures, but that's a reality. We cannot escape it. And that's where the concept of credit insurance comes in, wherein it talks about that, God forbid, this delay, when it turns into a bad situation, you know you are covered. Now, I think I have already provided you the update, and as we know that obviously it comes out that everybody is facing this situation of a huge tectonic shift in the way the business is being done. So my first question actually goes to Tim, who is our global leader for the practice, have been in this business for 3.5 decades. Dear Tim, how do you read this situation globally in terms of COVID?
Thank you, Akshay. Yeah, I mean, COVID has affected us all. COVID has affected us globally. I think on Sanjay's opening slides, he talked about a prolonged recession of the global economy. We're certainly seeing a weakening of most countries' fiscal position. And for me, it's all around liquidity. It's around having companies that have sufficient cash to feed their whole trade cycle, to support their customers, and also to pay for their suppliers. And there has been a significant reduction in liquidity over the past 7 or 8 months that we've all been going through lockdown. One of the things we've seen, or some of the things we've seen, includes sort of cross-border trade has been reducing. We've certainly seen from our perspective, turnovers of our clients reducing in some industry sectors quite dramatically, and I'll come a little later to talk about sectors. There is this huge uncertainty, a huge uncertainty globally about what is going to happen next. Some of you are already going through second phase of COVID, and other parts are still in the eye of the storm. We look from Latin America that are still having some significant issues through that first wave, right the way through North America, where there have been some significant peaks. The UK are now back into a peak, and we're about to go into our second phase, we believe. Across Europe, that's the same. In Africa, there's certainly a surge in numbers going through Africa at the moment, despite their inability to test everywhere. And in Asia, they're probably now out of their second phase and starting to look towards what's going forward and what does the new normal look like. So you have to balance that of what's going on with the fact that trillions of dollars have been lost out of the global economy. You've got countries looking at protectionism, put the US first, put China first. It's all around trying to understand how they can deal with their own local fiscal issues before they start to globalize. Up to 40% of a company's asset base is normally in receivables. And one of the things we have found, Marsh has found quite useful, is using bank financed policies and support assignments to be able to use the trade credit program to actually help uplift both your negotiation on that liquidity and an additional ability to get liquidity. As actually I already mentioned, Marsh has been campaigning quite thoroughly for the past 10 years, maybe a little more, with your governments to try to reinstall the capability of banks purchasing trade credit insurance, and that has to be important. That is very important around what comes next and what we can expect going forward. But generally, businesses are still robust. We have found our own business has been robust, and I'm sure most of you are finding your businesses are robust still. Despite the fact that you have a lower turnover, despite the fact that you have a different supply chain, despite the fact that some of your customers may default or not. What was interesting for me in the 2 polls was that 93% of you either agree or strongly agree that some of your customers may default on payments. That's a huge number. That's an absolutely huge number. And were we to have asked that question this time last year, I would imagine that number would be closer to 25, 30, 35%. So almost a trebling of concerns by companies. And that's not just the people on this call. That is a genuine global sort of perspective we're seeing. There are so many companies now that fear for their payments being made. And the second question that actually also asked about extended payment terms. I mean, the one thing we are seeing from an underwriter perspective is their non-payments, their reporting of overdues is going catastrophically increasing. And this is a part with all trade credit insurance policies. There are certain administration tasks that every single insured customer must participate in. And a part of that is at the end of an overdue period, an end of a collection period, a debt becomes overdue. And normally that can be 60 days beyond due date, 30 days beyond due date, on occasions, 90 days beyond due date. But actually beyond that, you have to report that debt to an insurer. And we are seeing huge numbers of non-payments being pushed through to underwriters. Now, underwriters will look at these and recognize that a number of those can be collectible. And of course, 50%, 60% of that can be collectible. But that's where they see their losses coming forward. And that's why I think from Sanjay and Akshay, and thank you for your introduction, they concentrate on the losses. So for me, what do I read of it? Well, cash is king. Underwriters like to see companies pay debts on time. They recognize through this period they're not going to pay, so they make alliances for that. They recognize that. We've seen government fiscal support. We've seen some stimulus in most countries. We've got government supporting just basic trading in some countries, mostly across Europe, but also in some countries in Asia. And all of these things have helped us to survive so far. But over the next 6 months, as we go through this next period, that will become even more difficult. And either we have to rely upon government stepping up still further, or we have to rely upon third-party insurers working with our client base and understanding more fully what they expect going forward for the next 6 months.
Yeah, thank you, Tim. I think in India too, we have something called Atmanirbhar Bharat, that is self-reliant India. So yeah, the protectionism is increasing. Tyler, I would, before moving to the next topic, I would want to have your views on how you are looking or how you are reading the situation looking at Asia.
Oh, sure. The polls come up,
no.
but no, I can respond first of all. No, so actually, first of all, thank you very much for the invitation to speak to the audience here today. Thank you to you and Sanjay as well, and it's a pleasure to speak to everyone on this call and on this topic that's obviously is a very fluid situation, as Tim referred to in several instances during his remarks. Following from some of Tim's points as well, I think if you look back at the global financial crisis of 2008, 2009, the world wasn't as interconnected as it is now, and that's a pretty important point. Also as well, I think Asia, relatively speaking, did escape the GFC quite unscathed compared to, say, North America and parts of Western Europe as well. And this time you're seeing that it is really it's really a global economic crisis that hasn't taken place for since the global depression of the early 1930s. So this is quite a unique set of circumstances that we're seeing here, where you have obviously the healthcare crisis that's then precipitating the global economic crisis that we're seeing here now. In terms of how Asia has been impacted, as going back to the point I mentioned before, it's really because obviously it's much more interconnected now than it was 10, 11 years ago. And as we've seen the healthcare crisis of COVID-19 obviously starting in China and then moving on a scale from east to west, as countries go into lockdown, severe lockdowns, as in the case of China initially in January, and then moving across. All of this wasn't taking place at one time. So what you were seeing was obviously the delays were occurring, first of all, in China, as the lockdowns, especially in Wuhan and the area there, were very severe. And the rest of the world being relatively unimpacted, to then moving across to the rest of Asia, and then slowly moving into Europe in March and April. North America as well, and political turmoil there, and as you would have had manufacturers in China looking to sell into companies and businesses in North America and Europe, the supply chain was impacted by that, because obviously the factories in China were shutting down in that period in and around Chinese New Year at the end of January, and that led to a sort of drying up of goods being supplied to the Western economies and throughout Asia as well, the rest of Asia. But as we've seen, obviously, China came out. China was obviously the first to fully emerge from the lockdowns in sort of April and May. However, it's gone on and continued to impact them, because obviously the markets they're looking to sell into throughout Asia, more predominantly into Western Europe and North America as well, they've subsequently been incredibly impacted by the impacts of COVID-19, the severe shutdowns in those countries as well. So again, whilst here in Hong Kong, where I'm based, we're just coming out, or we just have come out of the third wave of sort of shutdowns as well here. There'll probably be a fourth one on the horizon as we go more into winter. As Tim mentioned, it's something that this is just a new normal. We have to live with what we're experiencing now, going through until the first, certainly towards the second quarter of 2021. And we've certainly seen that through the economic forecasts globally, but also the economic forecasts that the credit insurance have outlined as well. I mean, this year it's going to be a global contraction of GDP of 4.8%. Next year, the forecast is obviously an increase in GDP of 4.4%. India, the contraction this year in 2020, it's forecast to be over 8%. So these are figures we haven't really seen, or we haven't seen for a substantial period of time, nearly 100 years. Australia going into recession for the first time in 30 years. It is really a global event that every single economy is being impacted by. The carriers themselves are very much impacted by that, to varying degrees throughout Asia and the economies here. The Chinese economy, it's picked up again. Retail sales showed a bit of a bounce back in August and September. But again, as we see that now, obviously the insurers are very concerned about the slow payments we're seeing in India predominantly, but also in countries like Indonesia, Singapore and Malaysia. A lot of that is industry related, but it is across the board, and not many industries are really getting through this unscathed.
Correct. No, Tyler, I fully agree. Because there's something which, when you talk about 4.6% contraction, frankly, I've stopped tracking the numbers for the simple reason. Every day you find a new number coming up that, okay, the contraction is this, that. If you remember in the last presentation we did, we spoke about that few countries like India and Indonesia and a few countries will grow marginally, maybe 1%. And we were happy that at least somebody is growing. But that's not the situation. So we don't know what is there. The second topic is actually connected to it, where we are talking about geographies and impact on sectors. But before, I would want to have a small poll. Niladri, can you just go pick up the poll, please? Niladri, the poll. I know my customers well and know their customers as well. Now, this is something which people speak about. I have full visibility of their financials and business plan, and no customer will ever default to me. How sure are we about this statement? That we have full control and visibility on our customers and their customers? Because most of the time, it is not your customer who goes bad. Sometimes their customer goes bad, and then there is a dominoes effect. I think the beauty of this poll also is that it aligns with our earlier poll, where we are talking about 95% people have experienced delays. Here we are talking about that not a single of us is sure that we will not face a default. I think this is quite a discovery, and quite an understanding that we all are on the same page. Niladri, we have another poll. I move? Okay. So Tyler, just taking the point from where you were speaking in terms of how we are looking at, okay, sorry, there is a hole by mistake. The question is that the world is seeing a double shock from the demand side and the supply side. What is your opinion is the best strategy to tide over this situation? Diversification, realigning to be more competitive, or just lying low for the storm to pass, which we don't know how long it will be. Thank you. I think that gives a decent insight that while most people are talking about realigning themselves, there is a good share of people who want to wait till the storm is over. And this brings to my query to you, Tyler, that in the start of the discussion, we talked about country rating falling, construction, retail, travel, leisure, certain sectors are facing issues. Certain countries like most of Eurozone, India, China, they have contracted sharply in first 2 quarters. But we also saw China's sudden swing. We saw tremendous demand in ICT and mobility, where actually companies were grappling for breath to meet the huge demand. Countries like India are having huge impetus from government, where contracts worth $1 trillion are being awarded for road construction, which will spur the demand of steel, cement, and construction equipment. Now, all this thing makes the situation pretty confusing for anyone taking a decision. So what I want to probably ask you to throw some light for our clients is, what do you think in these 3 quarters now over, the sectors which have fared well, who have survived or are surviving, and who have or are on the brink of perishing in a post-COVID scenario? And maybe then I can talk to Tim about geographies.
Yeah. Okay. No, thanks. Thanks, Akshay. I mean, look, you touched upon some of the key trade sectors that we've seen in Underwriting. You know, a lot of people obviously seen thrive in this type of environment, these type of circumstances. If you look at the tool we're using now, Zoom, for communication, I mean, the share price there, I think, has increased 5-fold since the beginning of this year. So we've certainly seen communication thrive. We've seen ICT, as you mentioned, even food retail, pharmaceutical industry, healthcare industry. We've seen all of these industries doing exceptionally well. The sort of drive and the push to work from home has really benefited a number of those industries for sure. The ones that we've seen sort of struggle, the obvious ones, you mentioned those at the outset, so, as did Sanjay. I mean, obviously the airline industry, those numbers are way down, and the airline industry is not going to recover until the end of 2021, if not until 2022, when things are even back to relatively normal. Business travel, is that ever going to be back to normal and what we've seen before? Hotel industry as well, logistic companies, this is what, these are the areas that we've really seen struggle overall. So, if you look at what the credit insurance industry has done in regards to these particular trade sectors, retail as well, especially in the clothing industry, they've been very challenged in terms of maintaining coverage. They've looked to maintain as much coverage as they have, but for ones where there was really clearly going to be a default and insolvency based on the stresses and strains that these particular trade sectors were finding straight off. I mean, the airline industry, we saw some very high profile insolvencies there with Virgin Australia, Thai Airlines, to name but 2 of those which are very prominent. So those are ones where there is still coverage in place across the airline industry. There is still coverage across in logistics and other industries. A huge amount of exposure in retail, non-food as well, because credit insurers can't look to cut off exposures like that. They can't look to cut off companies because it's going to have obviously a huge impact, and a big chain reaction will take place as well. Tim touched upon this before in some of his opening remarks, where he says we have really seen the credit insurers to date anyway handle the crisis better than they did in 2008, 2009. where there were some very mass cancellations of buyer limits. Most of that has really been assisted by government support schemes, government reinsurance schemes, mainly in Europe, but elsewhere as well. There have been discussions here in Asia, but nothing's really materialized as yet. And that's really helped to maintain the coverage for companies in Asia, exporters in Asia, selling into those markets. And I think that support has really been crucial to maintaining the coverage as we've seen it as well. Are we going to see this continue? Almost certainly. If you have a look in the retail sector, for instance, the time when those companies go into insolvency in all geographies, it's usually after the Christmas period when they do have the most cash on their books. So we will see a pickup in the insolvency trends in the retail industry, especially non-food, post-Christmas. So that's obviously a concern to the credit insurers and obviously to suppliers more pertinently. And we will see increase in insolvency across other industries as well. The industries that have really thrived, they'll continue to do that, and there'll be additional demand for exposure across these. As how long can the ICT sector continue to increase their sales? There's only a finite amount for them. A good sort of increase across, say, PC sales is 3%, 4%. They've obviously seen that increase substantially more than that in 2020, but can they continue that into 2021 as a sort of glut of supply can only sort of go so far.
Thank you, Tyler. Actually, I wanted to go to Tim, but Tim have covered that part of global or geographical spread. So what I'll do is that maybe I'll club it, because we are also having a time this thing. So we'll club it over there. Niladri, do we have poll questions before we ask Tim for his view on using trade credit for sustenance and growth?
No, we already run that poll.
Perfect. So Tim, basically what
I just say that, could I just add a couple of things just to Tyler's comments, just around.
Yeah. Sure.
There are some key points which is difficult. I think you mentioned earlier on around, Tyler mentioned earlier on around globalization hadn't really occurred when we had the global financial crisis, and it has gone forward now. However, what we've noticed, certainly cross-border mergers and acquisitions have seen a sharp decline through this COVID period. We've really started to see that globalization has slowed. I think somebody mentioned around the US elections are coming up. And what we're going to see that is President Trump's intentions, which is to make sure US is first, or Joe Biden's looking at his economic platform, which is there a redistribution of wealth, big spending, and whatever. But neither candidate has a real intention to look at reducing the overall debt of the US, which is astronomical. You look at China's recovery, which has been, as Tyler suggested, the first one back in recovery. And although it's not unilateral over all industry sectors, it is quite resilient. It's got a lot of investment going in. They're now starting to slow down with their fiscal easing. Look at the Eurozone. We look at potential unemployment issues. And in most large EU countries, we've got furlough schemes, which are coming to be extended again to the end of the year. That's costing governments fortunes. Are we able to find more additional support from governments? If we look at Germany, who's had a very strong consumer-led economy, that's definitely declining, and they won't go back to being a positive GDP growth for maybe 1, even 2 years. It could be as late as 2022. 2022. If you look at France, again, huge unemployment. Italy, they've got a huge issue there, and Spain. I think the key areas for insurers that they saw geographically, there were 3 key peaks. I'm very sad and sorry to say, from an insolvency perspective, India was one of those key peaks. The other one, and the largest by far, was Spain, and Spain has gone through some significant issues, and the other was North America. So Sorry for interrupting, actually. That's all I just wanted to say on.
No, no, perfect, sir. I think this goes in line actually, because what we are observing over here is a classic case study of contradiction. So on one side, we have underwriters undertaking an extensive exercise to realign their exposures, resulting in a very tightened credit environment. On the other hand, we have seen a surge of new clients who have to sell to survive and come back to normalcy, and they want to use trade credit insurance. Now, what we are looking at is there is a huge exposure spanning across. What we are looking at is in terms of means what I want you to speak about is would be what should be my client, say sitting in India, his thought process should be with respect to trade credit insurance. If you can give some perspective as to how insurers are faring in it and how we can use trade credit insurance for our business growth and development. Tim, this is for you. Yeah.
Okay. So I've got a couple of slides on this. I don't know if we can put up my third. So one thing Marsh has done for the past 9 years now, this is year 9, we have done a colleague survey. So what that means, we go to all trade credit insurance colleagues within Marsh globally. There are around 410 of us globally across 51 countries. And we ask them basic questions. We ask them questions about how underwriters perform, whether we're getting more interest in the product, less interest in the product, whether claims are being paid or whatever. And I've summarized these in the next 4 slides, which I'll go through quickly. So what we do, we send this survey to 410 people. We had just over 65% response, which is pretty good. It covers the period solely from COVID. So we've deemed that to be the 1st of March globally, although we know it occurred a little earlier in China. So we've deemed it from 1st of March through to the end of June. We've asked everybody for their update. And this is what Marsh sees. This is what Marsh sees locally. You can see this is spread across 10 or 12 geographies. We split it by individual region from our perspective. I think if you circle across, you've got 6th or 7th one in is global. So we have an overarching global team which solely looks after global multinational firms. They also have their perspective, and their perspective is as shown. And what this tells us is whether the dark blue at the top is where we've seen premium increases of 30% or more. And then we've seen increases between 20 to 30%, increases between 10 to 20% is the grey number, and then increases is the orange number between 0 to 10. Quite surprisingly, the only area where we had seen some decreases through that period was Asia. And we also saw a little bit of green, which is the remain stable. So Asia is the one place where we have seen premium rate reductions. And I guess, although I know Akshay's smiling because he knows what I'm going to say, that maybe just be the manner in which you negotiate and then negotiate and negotiate again. And all that's fantastic. That is really, really fantastic. But I think you can see from the global position, actually premium rates have increased quite substantially. And that is what insurers are doing. They've made a fairly strong mandate that premium rates are increasing, and it depends on the industry sector, it depends on the geography, as you can see from this slide, as to whether it's a small, medium or large increase. If we can go on to the next slide, please, which then talks about credit limit underwriting. The one thing I would point out from this one, just before I go through the details, is please note this is a range between 86 and 100%. Everything below 86% is all blue. It's all blue, which is deterioration. So the blue denotes deterioration, so more conservative credit limit underwriting. The orange denotes an unchanged position. And where we do have some grey, it means better credit limit underwriting. And if I look at the grey, you can look at Australia and New Zealand. So 91% of our team in New Zealand are seeing deterioration and 9% are showing some improvement. And the only other area where we're seeing some improvement is in good old UK, where just over 96% of our team are seeing deterioration on more conservative limit underwriting. And in those last 3 to 4%, they're seeing an improvement. but almost everybody there is seeing deterioration. Now, what does that mean? I can put this into some numbers for you all. There is, in a normal world, so if we go back to 1st of January 2020, over $2 trillion of credit limits were being underwritten by the insurance market, by the trade credit insurance market. That does not include the ECAs. And if we look at the ECAs, certainly in China and across Asia, you'll know yourselves that some of the ECAs are writing, again, quite considerable credit limits. They might even be writing as much to match that number. So you could be talking somewhere between $4 to $5 trillion worth of credit limits being underwritten globally through ECAs and private market. These numbers, by the way, are solely looking, our numbers are solely looking at the private market. What has the private market done? Well, the three largest, sorry, go back to the previous slide, sorry. So our three largest insurers are Euler Hermes, Coface, and Atradius, and they or their joint ventures probably are around 75 to 80% of the global trade credit marketplace. They have been reducing. So we know that Euler Hermes have taken 9% out of their figures. We know that Atradius have taken just under 9% out of theirs, and Coface have taken somewhere between 10 and 12% out of theirs. What does that mean? In reality, it means around 200 billion of cover has disappeared out of the marketplace. But that still means that there's still this 4 trillion plus number. And certainly from a private market, it means there's still just under 2 trillion of limits that is being underwritten through the private markets. And that's very important because, as Tyler suggested about industry sectors, you talk about IT, consumables, telecoms. We need more cover in those industries as those industries continue to surge through COVID. And then you look at travel, you look at leisure, retail, certainly non-food retail. We need less credit limits on those at the moment. So although it's not balancing out, and underwriters are definitely taking some cover away, it is a picture of what's going on in the world.
So I have a query actually with you that this is something which I'm asking on behalf of my clients actually. What has happened is because of COVID, a lot of new clients have come in to seek cover. Many have come in with sectors which are facing difficulties with underwriters. So as you rightly said, yeah, almost $4 trillion of cover is available, but it has to be in the right segment or sector or geography. Now, if I have to speak to my client, now what they expect is that they expect 100% acceptance of buyer, which we know that was not possible even in good times, as you said, 1st of January 2020. So today, if I compare it with 1st of Jan 2022, say today, what should be a good acceptance rate overall for a portfolio of buyers, which a customer looking at it should feel that they have got good deal? Because we know that it's not cast in stone, obviously it will change with time as things improve, but these are conservative times, so the acceptance rate is coming down. So what do you think would be a good range for somebody to take a decision that I'm putting the money, we don't know, there is an uncertainty, it is good to buy insurance, at least I'm getting covered for this month?
Sure, yeah, I mean, that's a great question actually. And I think one of the things that it is difficult is not only when to buy the product or if to buy the product, but also is the product good value. If I go back to 2019 and before, both Tyler and I have spent tens of years in this industry, so we have a very broad knowledge. I would say acceptance levels range between 70, 75%, maybe 80, 85% in general, depending on industry sector. And we were genuinely closing lots of programs with that sort of level of approval and acceptance. Now, I think we've started to see that significantly reduce. So we are seeing 60%, 65% acceptance ratios being at that right level, and people are still looking to buy. And again, I would just go back, I'm sorry to go back to this again, but I would just go back to the original poll questions you made. Poll question number 1, do you think there is a possibility of some of your customers may default? And actually 93% of you said yes, they would. Are you extending payments? Absolutely. So these things I think will be seen as being still good value because they're still covering the majority of those overall outstandings. Personally, what I've seen, I've seen policies through this pandemic close with 75 and 85% acceptance ratio. my worst acceptance ratio. We've had some real problems out in Turkey. And we closed a program 2 months ago, so back in August, which had a 26% approval ratio. But the reason the client bought that 26% approval ratio was they recognized that as we start to move out of a recession into 2021 and beyond, that they wanted to have the base of both credit management procedures, which the policy supported, but also they wanted to have that baseline cover that they know could only go in one direction. And we've agreed with that particular insurer quarterly reviews on credit limits, and we're hoping that that 26 will become 28, 30, 35, etc.
Fair point, sir. Fair point. Yeah, that's what we are also speaking to our client. You have 2 more slides and then we move to the next topic, sir.
Oh, absolutely. So very quickly, if you go on to the next slide, please. This is just, I thought this was interesting for everybody. So we talked about where claims were going. Grey, unsurprisingly, is increasing in claims, and you can see our oranges also remain unchanged. There is a very small window of 10% of our clients and our colleagues see that claims have actually decreased in Australia and New Zealand. I'm not quite sure why that has happened, because everywhere else in the world we've seen huge changes, and see the numbers yourselves that it's significantly increasing. And then my final slide, sorry, slide 4. Demand for credit insurance. And I think this is important because it comes back to Tyler's point about trade sectors. It comes back to my point about geography. There is a definite increase in interest in this product. The grey areas, the yellow area is significantly increased, but a definite increase. Now, if I look at the global number, which has got the largest yellow significantly increased, more global firms are now looking at trade credit insurance than they have ever before. And that's from a significant amount of experience. I've been with Marsh for 3 years prior to that with a competitor, 36 years in this industry. Global companies are definitely using trade credit insurance more and have a higher level of interest. Now, they may have to compromise on certain things at the moment, not the least of price is definitely more expensive. Cover is less than they had thought, but to get their foot onto that trade credit program will give them the disciplines to help see through what we're going through at the moment for the next 3 months and what we anticipate to go through in 2021 and beyond.
Gayatri, next slide, please. Can we have the poll and move to the next topic, please? Due to the pandemic, there is a possibility of default. Do you think trade credit insurance will be an effective tool to support your business and protect your receivables? So we have 80% plus people with 53 saying that it would be a great tool. I fully agree with that. Reladri, do we have another poll? This is one statement which says that my expectation from the underwriter is to not just agree to cover every buyer, but also provide the rational and latest information on each buyer so that we can do business with only good buyers. Strongly agree, disagree, strongly disagree. So we have about 90%, 91% people agreeing that they would want underwriters to not only just give limits, but also give an insight, because at the end of the day, at least 10 to 15% of the loss have to be borne by the client themselves. Next. Now, coming to the topic and extending this discussion, and we will make it short because we have just overshot our time. but it's always, I'm a greedy man. I really love listening to all this wisdom which is coming from you guys. For my client's perspective, and this is the reason why I asked for this question. Currently, what is happening is that the market is facing a double shock wherein both demand and supply have become a challenge, which has shaken the core of supply chain management, how we understood it earlier. So the moot point of discussion, which our clients are having in their strategy war room or strategy room, as they call it, is how they should be realigning their supply chain management. And what I want from you, and maybe Tyler can also chip in, is if you can share some examples or how you think the supply chain is going to change in the later part of COVID and post-COVID era.
Sorry. Actually, was that myself or Tim to go first?
Either of you can.
Okay. I'll sort of pick it up first of all. So, look, this is, as you say, it's highly relevant actually in today's economic environment for sure. I think if you look at the supply chain management and what some companies, what multinationals were looking to do, even pre-COVID, was to somewhat diversify away from China. If you have a look at the movement of manufacturing bases, especially to Vietnam, over the last couple of years by Korean companies, by Japanese companies, that's really, I think, a sign of things to come. And so that was happening anyway, with or without COVID-19. So we've certainly seen that happen, and that will continue to happen. I think there's certainly going to be a continued fallout. Tim sort of touched upon this with the upcoming election in 3 weeks' time. Whichever candidate is elected, I don't think they can be seen to be soft on China. So whether the Democrats get elected back into power, I don't think they're going to turn around and push back all of sort of Trump's positions. They might take a softer view, but it's certainly not going to be an about face from where they are now. And I think that sort of trade war and that general distrust between the two largest economic countries in the world will continue, at least for the foreseeable future. It's not going to be a quick solution, unfortunately. And of course, that has a knock-on effect for other countries in the world, and it does bring about opportunities as well. I think we'll see the supply chain movement continue to sort of move away from China. I think China will continue to be a big pull, though, obviously given the size of the population there, the manufacturing base and hub suite that they have set up there, established. And you've seen the likes of Tesla building a huge manufacturing plant in China. So there will continue to be investment in that country. But I think throughout ASEAN and throughout India, you will see an increase. Yeah, a huge benefit for sure.
So what I'm also seeing, Tyler, is that it is not just on the procurement side that there is a big change which is happening, but also towards the sales side, where our clients are not, or they may not want to rely on their conventional markets, where probably, and they are exploring new markets, so their buyer base is also increased apart from their supplier base. And I think that is where probably credit insurance fits in and assist clients to manage their supply chain more efficiently on both the sides, actually.
Yeah.
Any comment from you, Tim?
Yeah, I mean, that's a very relevant point, actually. I mean, one of the key advantages of credit insurance is you have suppliers globally who are then selling, if it's a supplier in China or a supplier in Japan, they're selling into Brazil, into Argentina, into South Africa. They don't have any idea. They might not have agents on the ground. They might not have operations on the ground in those countries. They don't have any idea what those buyers are, how long they've been established, the reports they're getting through, is this accurate information? So the credit insurers, at least the big three carriers, who globally dominate the private market up to 85%, Euler Hermes, Coface, and Atradius, they have operations in the ground in all three of those countries. You're just using those three countries as an example. So they can go out, they've more than likely acquired up-to-date financials on those buyers. If it's a buyer they're not aware of, they can send out risk underwriters to go and meet those buyers, again, to get information, to get more insight into the operations there as well. So all of that will give a supplier in India, for example, it will give them more comfort to know that someone is actually out there visiting these key buyers. And these are markets that their competitors in India might not have the ability to sell to. They could be selling to them blind. They don't know what the operations are like in those particular countries. And they'll have an added advantage, a competitive advantage in working with the credit insurers to then sell on open account terms, whereby some of your competitors could be selling still on secure terms such as lesser credit.
So what I understand from my clients is that obviously when you're looking at supply, that is your buyers, obviously with credit insurance, you have this help. But if you are looking at diversifying yourself in terms of sourcing, if your client's market have a credit insurance player covering them and they have a visibility of you, then it makes immense sense. And then once IRDA approves, probably supply chain finance will help you maybe get better finance terms. You can monetize your payables. There are opportunities are huge. Tim, any comment from you? And I think then we have time to close. Niladri has already given me a signal, and we want to get some 10-15 minutes for question answers as well.
Sure, yeah. My only other comment, just to support what Tyler said, is financial institutions are big into supply chain management, and the point, we've got to get India to a state where banks can start to support liquidity, can start to fund, and can start to be part of the credit insurance circle. Once that arises, then I think there are banks willing to invest in supply chain management. I think that is very interesting, and it will be a key to the future support of most countries. At the moment, I think a lot of countries are struggling to attract foreign investment. I mentioned before about M&A activity, but it goes beyond that, and it does go into the supply chain process. Also, we are seeing some countries and certainly some companies within countries having a very anti-China method at the moment. Tyler already mentioned that was previously working on with Vietnam becoming the next sort of growth area. There are also countries in Latin America which have similar sort of low-cost facilities. But I think multinational companies are struggling at the moment with their strategy around reshoring. Where do they go? Who do they go? Where do they invest? And I think that will be part of the problem going over the next 6 to 12 months in understanding how do we monitor and how do we get back to optimum production, the supply chain. I think that will continue to evolve through the end of this year and certainly through Q1 of 2021.
Thanks, Tim. I think now the only two small questions, which I have from my participants, and then I'll ask you the same for your feedback as well. Niladri, can we have the questions quickly and we open for Q&A? Okay. The COVID-19 has disrupted the global supply chain with centralized sourcing to diversified sourcing, standardization to customization. The supply chain management needs to evolve the post-pandemic era. How many agree or strongly agree to this, or disagree or strongly disagree? Well, 85% people agree or strongly agree to the point that post-COVID, we will see a sea change in how SCM is, and probably we can look at assisting with more deeper penetration of credit insurance. Next poll, Niladri. Now, this is the question which is there. When do you see the pandemic will end? 21, 22, 23, hard to predict. I think this brings a lot of extreme results, but we are looking at a fairly balanced results here. Okay, I think this is what I love about India, is that we are optimistic. With almost 52% people are fully convinced that by first quarter or second quarter of 22, we will be out of this. There's still a 48-50% majority or a part of participants who believe that it is hard to predict. We don't know. We cannot comment on it. Next question. What type of recovery do you foresee? Now, this is again one question, which is V-shaped, U-shaped, W-shaped, or any other alphabet. I'm not sure how the things would be. How do you think, Tim, Tyler, what's your view? What type of recovery do we see for the world?
Other, which is,
Other.
I think, yeah, no, it's the one that's been raised a lot by economists in the last month or so, the K-shaped recovery, based on different industries. So you'll see some industries like pharmaceutical, telecommunications, recovering much more rapidly, and others just continue in their doldrums and continue their sort of downward spiral, like airline industry and hospitality for sure. So I think the K-shaped one, but V-shaped I think is very optimistic, and I'm an optimistic person, so that's why I like the sort of Indian nature for sure.
Tim, any point from you? How do you look at it?
So for me, I still think the old Nike sign, the sort of the long
swoosh.
Swoosh, yeah.
I'm not sure what letter that is, but certainly that's what I think. I think we have to be prepared until there is a vaccine, that we will have some countries and some regions that constantly slip back into some form of a COVID restrictions style trading. Certainly as we're entering winter in Europe, that will happen again. So I see more of a slower response out. But I think countries and local economies have to get used to this new way of trading, and that will in itself bring out its own form of recovery. So I see that being a more elongated. I'd love to think we'd be out of recession in 2021. But if we are, I think it's going to be towards the latter end, certainly second half, maybe even Q4 2021. For me, probability is more back to usual, whatever usual will look like is 2022 ongoing, I would say.
Thank you, Tim. Now we have some queries. Mr. Valecha, if you are okay, we can open your line and you can ask your question with the leaders. Niladri, can you open the line for Mr. Ravi Valecha, please?
Yeah, give me some time. I'll just...
Mr. Ravi is the CEO of India Factoring, which has been supporting Indian companies.
Mr. Valecha, can you hear us? You can shoot your question.
Mr. Valecha, can you hear us?
Yeah, I can hear you. Can you hear me?
Yeah, sir. Please ask your question.
Thanks, Akshay. It was a pleasure to hear you and the team, Tim, Tyler, and Sanjay also. Wonderful to hear your feedback and foresights on the trade credit insurance. And of course, we look forward to hearing positively on the regulations turning around in India. That will be a paradigm shift. The question I have, in preparation for us to work out pre-work sort of once the credit insurance is open, some internal working is required, is a question which comes from our internal stakeholders is the credit insurance companies, when they're underwriting a risk in the buyer's country, they are underwriting for not just buyer risk, they are also underwriting the political risk and other risk as well. The perspective here is that when they are reviewing the risk in entirety, they would also be reviewing the risk of prevailing laws, regulations in the buyer's country, which also includes the assignment laws, the perfection of the assignment, and the ability of the insurance companies to collect. Is that an underlying assumption? Is a correct assumption? Or is there some obligation on the export factor or the import factor or somebody else to ask also?
No, that is your perception is correct. Underwriters look at various forms of information before they make a credit decision. It will start off with some fairly basic stuff, simple financials if they're available. If they're not available, they may go out to visit the client. They'll ask for management accounts or some sort of support. They will take into consideration lots of things. So trade sector, they'll take into consideration size. So they would look at a company with $1 billion sales differently to they'd look at a company with $1 million sales. They'll look at geography. They'll look at spread. They'll look and see what commitments that company has and how their payments have been made. They'll also have some very personal, very private information, which will be, as I mentioned before, every single policyholder globally has to report a debt as overdue. They'll go through their overdue files to see whether that company's ever been reported or been reported as overdue in the last 6 months, and would that impact. So they'll look at all of those things. They will then take into consideration the country risk, the political risk, the COVID risk. They'll look at all of those elements. And despite all of that, they're still writing some 90% of cover that they were writing pre-COVID. So you are correct. There are definite restrictions and requests around what information they will ask for, but mostly we find the process that underwriters go through is pretty sleek. They've got a well-worn and practiced structure now, where they have representatives in most countries, they have risk assessors in most countries, and they will take their review process quite seriously. Does that answer the question?
Yes, thanks, Smith. Thanks so much.
The next question for the panelists is from one of our clients. They have been with us for many, many years and are into auto segment. The challenge what they are facing is that their policy, because of COVID, most of their buyers in Italy and Spain, though they have been strong buyers, but the limits have been revoked, and he feels that then it makes no sense for me to renew the policy. Now, in a situation like this, how will you address it, sir?
Do you want to say that, Tim? Because it's Spain and Italy.
Oh yeah. So undoubtedly Spain and Italy have had some key issues, and there has been definitely some reduction in cover in Italy and Spain. Spain has the government has come out quite quickly around April time or May time to say they would not be supporting trade credit insurance. They did not offer a government scheme. Italy, we're still expecting some developments. They did confirm they were going to write a scheme just over 2.5 months ago. We're waiting now for it to be ratified and approved by Europe. In regards to if you're going to continue to trade into those two countries, is it worth renewing? I don't know the personal circumstances about the level of rejections, but certainly we have had some success in writing cover in those two countries, albeit not at the previous levels. So again, it depends on whether you're talking about going from 85% down to 75% or 60%. There are still benefits in picking up some credit insurance for those risks. From my perspective, again, just going back to the poll where a lot of people said that they were expecting to have some companies default, the difficulties underwriters face is they still don't know about the domino effect, or if a company goes into insolvency, how it affects other people. More importantly, when the fiscal stimulus from some governments start to reduce, so the actual corporate stimulus that they've been given, if that starts to subside, how will that impact the market? So again, I don't think we're out of the woods with losses in Spain or in Italy at the moment. And I think that's a broader spread across some of the other European countries that have not quite had it as bad. So I'm sure I'm slightly biased being a broker for so long, but there's still an extraordinary amount of risk being underwritten in those two key countries across Europe as a whole.
Thank you.
And just to, I was just going to quickly add, I know we're a bit pressed for time actually, I'm just going to quickly add to that. What we've seen recently in the last couple of months is that, you know, as a lot of past dues have been paid down. If you look at Europe, for example, that's a good example of that. As people have come out of lockdown, there's been an increase in revenue in the retail industry and other trade sectors as well. So what we've seen is that underwriters have assessed Q2 figures, Q2 financials, and for some buyers, they've actually reinstated coverage. We've pushed very, very hard for that, and we've been successful. Obviously not across the board. We're not trying to misinterpret the situation. We've certainly done it and been successful in some instances, depending on the trade sector again, but even some challenging sectors, we've been able to do that, like automotive, like retail. So it's just the case you have to be persistent. We as brokers for our clients, we have to fight our clients' corners, but we have to choose our battles as well. We have to be smart about it. If a buyer is on the verge of bankruptcy, it's really, really hard to get that coverage reinstated. However, if they have had a positive Q2 and the financials have showed less of a deterioration in Q2, then potentially we can go back and push to get that coverage put back in place.
So what I'm understanding,
Final
and
thing,
probably the advice is, what I understand is that one is what we should be looking at is that yes, because of the crisis, the covers were cancelled, but the risk of default remains, a high risk of default remains. So the investment in the coverage should remain, and with every sale or with every payment cycle, there has to be a continuous push in terms of delivering or displaying with the underwriter how the payment track record is to push for higher coverage or reinstatement of coverage where the limits have cancelled. Correct? Yeah.
yeah.
Now,
The final thing I would say as well, Akshay, just on that point. I mean, this is a global economic crisis none of us have ever experienced before. What we can tell you from historic other crises is as we start to recover, then that is the most difficult time and the most extreme time when we see peak insolvencies. And that's because people now think we're now out of COVID, we're now out of recession, we can sell to everyone. And that is where insurers mostly find real losses and where we see significant levels of insolvencies and defaults.
very important point, yeah.
Out of a recession, whatever sort of recession, even one that is unprecedented that we don't know a great deal about, coming out of any recession is not necessarily the right time to lose some form of protection like credit insurance.
Correct. I think this is very important because what we are seeing, and this is also one of the questions from one of our leaders, is that currently most of the governments have they're stopping companies who file for bankruptcies. Like in India, we have this challenge, and there is one question which I'll take. But this is a challenge. So what we are not actually able to assess what the situation over there is, and people are just managing. And as you rightly said, it can just open the floodgates. Now, one point. This is with respect to World Economic Forum report, which was with the Allianz. They just shared a report which talks about 2021. We see an avalanche of insolvency. Now, the question which is coming to us is one. The rates are going to be hardening for some time or remain in the hardened phase. Till what period you see this thing continuously? For how long do you see the rate will remain hard? Second is, obviously there would be impact on reinsurance, and then the treaties will get underwritten at higher price. There would be constraints on limits. So with respect to that report, and you must have obviously done it, how do you see in credit insurance market things will start coming back normalcy?
Okay, so certainly I would agree with your comments. The government stimulus to corporates has been huge across the world, not just in India. Insolvency laws changed. In the UK, most of Europe, in Singapore, there was a stalling and a ceasing of companies being allowed to be pushed into some form of insolvency. What that has created is a number of zombie companies. We just don't know that they are zombie companies. They're companies that are trading historically. They would have been deemed to either be illegal or would have been deemed to be insolvent. Those laws have now changed and will change for the foreseeable future. The same as monopolies commissions. They've also declined and decreased. There are certain things where industry sectors as a whole have come together to try to find a route. Things like supply chain, funding, et cetera, So all of those laws have been changed, and one by one, as we start to go towards the new future, those rules will come back into play in a different form. And at that time, companies will find themselves either in a position where they can't sustain trading or they're unable to sustain trading. So again, back to your point, I guess there will be, we expect, a large increase in insolvencies through 2021, with a likelihood of some of that falling into 2022. We have to remember the governments that put state schemes in place actually agreed with the credit insurers that they would cede the majority of the premium they were paid for 2020, for which governments would pick up any losses. And although there have been losses because of other government stimulus, you've mentioned about the insolvency laws, et cetera, there haven't been as many as expected. So going into next year, that's when we see this waterfall.
Huge. From
a reinsurance perspective, most credit insurers renew their reinsurance treaties on the 1st of January. There are a couple in July which saw some fairly healthy increases. and 2021, January the 1st, won't be any different. Marsh has a reinsurance broker called Guy Carpenter, and I meet with them every 8 weeks or so to have a discussion around the marketplace. It is definitely tight, it is definitely tough, and rates are definitely increasing. But my last meeting was the second week of September, so probably 4 weeks ago. At that time, we still anticipated from a credit, surety and bond perspective, there would be sufficient capacity in the marketplace to accept all the insurers' needs. Now, the question is, however, will the insurers pay for that? Because any reinsurance cost comes straight back to the customer. So I think there will be sufficient capacity. Will there be that wriggle room to be able to find the right deal and get the right costing? Probably. We are expecting the avalanche of claims in 2021. Reinsurers, just as all of us on this call, can see exactly what we can see. And if the storm is coming, they're going to prepare for it. Preparing for it will be by way of premiums and indemnity levels. So that is what I see.
Thank you. So there is one question.
I was going to, sorry, actually, I was just going to quickly follow up from that because I know we're a bit tight on time. It's just, I completely agree with everything that Tim mentioned. It's the last hard market that we saw come into play was really in 2009, 2010, so 10 years ago on the back of the GFC. We've had a soft market ever since then. You could see even pre-COVID-19 towards the end of last year that rates were starting to harden. But as Tim mentioned, now with the cost of risk, obviously the cost of reinsurance, subsequently the cost of risk going up for the insurers, rates have gone up quite significantly across the board in every region. My thought, again, throughout all of 2021, that will continue. And we won't see rates going down, I would feel, until probably maybe even the second half of 2022.
Thank you. So the next question is only for me, and then a last question we will take and we will conclude because we are already half an hour overshot. Thank you for your patience. So the question is with respect to Indian insolvency law. As you know that currently in India, the government is disallowing, they have put in certain laws with respect to restricting companies from filing into bankruptcy. Now the question is, what will be its impact on credit insurance space or placement of new policy standpoint and claims perspective? And I just want to assure Jyoti Krishnanji that there is zero impact of this because this is a temporary phenomena. As Tim and Tyler said, 21 will see when such restrictions will be over, then only we will come to know about the situation. Insurance is happening, and Insolvency Act is not the only way to recover money. World is going through crisis. We are binding new programs. There are claims are being paid. Claims are being processed. So insolvency law does not have much impact on neither on placement of new policy nor from claims perspective because it just delays the whole process, that's all. And one last question. So I hope I have answered. If not, we will address, we'll write a mail separately to you and maybe then we can have a discussion on this. Another one comes from Mr. Arvind TCA. He has been a banking veteran, sir. In India, his last position was in Deutsche Bank. He says that his firm, now he has retired, so his firm specializes in securitizing supply chain pools of dealers and vendors across multiple buyers. So his question is, do you see insurers willing to look at supporting securitization type structure in these times?
Yeah, I mean, yes, is the answer. Certainly, food is one of the markets where we've all seen the progress and process there. I think it depends. I mean, there are certain types of food and certain commodities where the commodity traders have been specifically hit through these past 6 months. So if it is food retail and that, then I think underwriters are quite open and supportive. If it becomes into the sort of more raw materials and the commodity style, I think we've only got to look, well, to Singapore and a couple of other places, London as well. Commodity traders have had a specifically difficult time over the past few months. And going beyond that, you look at the GCC, oil prices, whatever it might be. As soon as you start trading in those sort of commodities, then I think insurers have been burnt quite badly and need to be persuaded. They do have some losses, but they've also had very significant losses.
Because of losses in current time, I think the appetite is restrictive. Yeah. So, yeah, I think we are just on time. Atul confirmed me it was anyways 90 minutes. So it was up to 5:30 and we are dot at 5:30, 28 actually. So thank you, sir. Thank you, Tim. Thank you, Tyler, for spending time with us, giving us so much of insights. And I want to thank all our clients and prospects who took out time to attend this webinar and ask so many questions. There are some questions which are unanswered. What we'll do is we will send a one-to-one mail addressing the query and we can engage with all of you. Thank you, sir. Thank you. Have a great evening. Stay safe.
Thank you, Akshay. Thank you, everybody. Take care. Stay safe.
Thank you very much.
Thank you.
Thank you.
Bye-bye. Bye-bye.